Just as the country was beginning to slowly emerge from pandemic shocks, another plague hurting emerging market currencies has hit the Uganda shilling. Over the last 3 months, from 3,510 against the dollar to 3,800 now.
Where do we get forex from? From our exports. Our export markets are also subdued, and therefore supply is constrained. We have higher demand in the domestic markets in terms of FX, but supply does not match that demand. So the imbalance causes this shortfall and puts pressure on the currencies. So that fundamentally is one domestic factor that we need to understand. Two, the whole cyclical demand issue before the closer to the end of the financial year is another aspect.
The central bank may have no choice but to raise lending rates to check rising inflation. And yes, at today's monetary policy meeting, the governor pronounced himself more monetary tightening
to contain demand pressures until supply catches up. Accordingly, the MPC has raised the CBR to 7.5% and maintained the ban on the CBR at +/-2 percentage points. The Bank of Uganda will continue to raise the CBR until inflation is firmly contained around the medium-term target.
Even then, the struggle with elevated price levels, it appears, is here to stay, now fueled by the global demand for energy, among others.
Oil prices, if you look at the demand now across all emerging markets, energy demand is one of the factors that is driving the weaknesses of all emerging market currencies globally. So we require a lot more dollars to be able to import almost the same quantity of oil we used to import a year ago.
Experts now suggest that since monetary tightening and fiscal policy actions may not yield immediate results, government must check its rising expenditure as part of the way out.